global and domestic shifts. How can investors navigate risks while capitalizing on the opportunities? This discussion will explore the future of financial markets, regulatory frameworks, and the resilience needed to sustain investor confidence in the ever-changing landscape. With capital markets serving as the key driver of the economic growth, understanding these dynamics is more critical than ever before. Please join me in welcoming our esteemed speaker this evening, Mr. Tuhin Kanta Pandey, the chairman of SEBI. Warm welcome to you, sir. Thank you so much for joining in. And to moderate this session, I'd like to invite Siddharth Zarabi, editor, Business Today.
Very warm welcome once again. Last February, in fact this February, right after the budget, we had our speaker here talk about the macro position of India, the expenditure priorities, the revenue priorities, and all that had been done in what clearly was a very, very solid budget. And now, sir, you were moved from North Block to BKC. It's been a month. How has the switch been so far, and what kind of priorities have you set for yourself in this new assignment?
Well, I think Mumbai is just sinking in.
Well, that's not a comment on the monsoon. But tell us, what are the priorities that you have set yourself in the month that you've been here, and looking at the capital markets, the broader story of flows and what's happening as far as investor sentiment is concerned? How do you read the situation at this point of time?
So first of all, I think I need to emphasize that SEBI is a very robust institution, and that I said on the day I joined, it's been built over the years with successive leadership. And then it has also had a benefit of large number of institutions which the SEBI has built around it. And I believe that we have one of the best capital market infrastructure in the world. And how we can contribute to it, make our own contribution to it is an issue. We have to continuously meet the challenges in a dynamic environment. And what I at the time mentioned that we will have roughly 4 pillars, 4 T's so to say: trust, transparency, teamwork, and technology. And on trust, I would say that it is both internally as to how we build teams, and also externally how we build teams. Because nothing that SEBI needs to do can be unilaterally done. It has to be done in participation, in consultation with the general capital market participants. Now, the second is the transparency. In many respects, the transparency has been very, very high. I think in one of the regulators where a lot is put out in the public domain as a discussion paper, in fact, we have a regulation, how to write a regulation. So, and in many cases, the industry standards forums are there, ISFs. There is a primary capital market committee, there's a secondary capital market committee, several committees where they deliberate. And then these comments, public comments, are invited, and finally things do take shape. So therefore, the only thing is we can say is that we can give this process a little bit time, in terms of don't rush through things and deliberate it properly, so that I think we don't have to tweak it unnecessarily all the time.
Mr. Pandey, a month
back... The third, of course, was, as I said, that trust. I said at that time that the trust also extends to SEBI itself, and we need to actually look into it in a more dynamic way in the current context, and we have to have this conflict of interest a little sorted out in terms of what we need to do, and we will move in that regard.
Did you notice a trust deficit, and has that hampered the work of the regulator in any way?
I think the trust is something which has to be continuously held and upgraded. It's not that we could really say in terms of there is a deficit or there is no deficit. I mean, the question is that, as we evolve, and if we keep, next 20 years in mind, in 2047, how is our capital markets going to evolve? We need to really see what, in terms of all these 4 factors that I mentioned, trust, transparency, teamwork, and technology, where are we going to be? Technology is another one where, there is a huge amount of work has been done and will need to be done as well.
Absolutely. That's a very important point, because I wanted to, bring the attention of our audience here and everyone else who's watching us about how a couple of months ago, you and other senior officials wrote those very important lines on deregulation and getting the government out of the way, ensuring that there is perhaps going to be a deregulation commission which will come up with some very seminal recommendations. But from a market point of view, do you see the need for a similar deregulation exercise? Because certain participants say that in the past couple of years, there seems to have been a bit of a regulatory overreach. SEBI has got into perhaps so many areas, and that seems to have had an impact on regulatory certainty as far as markets are concerned, sir.
I think I look at it as a issue of optimum regulation, because if you really look at the capital markets, we have the companies on one hand, basically the issuers, and then you have investors, and then you have the market infrastructure where intermediation is done. And an efficient capital market will really say that, while fundamentally we need to have our capital market players in terms of companies which are producing goods and services are live and kicking, and they're working in a thriving policy environment in Indian economy. There are cost of the efficiency with which the intermediation is done, the trust with which the things are settled, which will bring investors in. And so therefore there will be a more and more money which is available both on the debt and equity side for the people to play. And so there is regulation is inbuilt into it, because it can't be just completely self-regulated, but there has to be an optimum regulation. If we are trying to do, so it's a question of striking a balance. If we do too less regulation, you remember there was also a global financial crisis. Absolutely. And preceding that, also there was a thing that a very light touch regulation was done. In fact, in many commentators said that the regulation was extremely weak, and that led to whole systemic issues which went into how the global crisis came in 2008. Now, again, if we try to do too much of a regulatory outreach, you would have another tier 1 problems. That we would be, tier 2 problems, where we would say that we will stifle the innovation, we will not be able to get work done, everyone will be going for paperwork, compliance burden will be high. So therefore always there is a need for striking a balance. Now what that optimum balance is, of course, it will, it's a matter of subjectivity. But then I think when we sit together, we can always thrash it out as to what optimum regulation is.
So Pandey, since you spoke about compliance burden and other issues, do you agree that regulatory shifts over the past couple of years seem to have made India less attractive to foreign portfolio investors? And if you do agree, do you think there is something that we can expect from you in the future in terms of reversing that?
First of all, I think the FPIs have been a very important part of the capital market landscape. If you really look at it, it's about $800 billion of FPI money has been invested, about $700 billion in equity, about $68, $69 in debt. And if you really look at it, in terms of flows, the flows have also gone up last 5 years. Of course, there has been some outflows of recently, and I think any kind of crisis, any kind of your, you know, your Vucanomics.
Vucanomics.
So, yeah, when you Vucanomics, you have, such a volatility and uncertainty, then obviously, there would be some churning and the FPIs can also leave. Notwithstanding that, I think it will be our effort to really see is that if there are any pain points, we just take care. And we did actually address many of those pain points earlier. And if there are other obstacles in terms of any uncertainties, which we create over and above what the uncertainties are otherwise due to economic factors and the geopolitical and geoeconomic reasons, we are definitely prepared to discuss with them and address it.
That's a very, very important statement from the SEBI chairman about openness and transparency in listening to feedback from market participants. But sir, a couple of months back, I was among many of those who had asked you questions about the taxation strategy that was followed with regard to capital markets. Now that you've crossed over to the other side in some ways, do you think that is also an issue that the policymakers in Delhi need to consider eventually?
I think you just a few moments before you said we should not have too much of an uncertainty. If some certainties have already come in terms of taxation, let's not unsettle it. I think the point is we have to live with what the taxation is and which I think is a reasonable one on the capital market side and move with it. We have sufficient, if you really look at MSCI US dollar returns, over the last 5 years, this is more than 10%, 11% in US dollar terms in India. And if you look at emerging markets, it's about 2% CAGR. And if you look at developed market, it is minus 2% in dollar terms. So India has offered 11% US dollar returns in MSCI to the FPIs. So, and this is, with whatever taxation that we have. So the taxation has been rationalized. And I think we have to live with that taxation, and we have to see fundamentally, if you really look at Indian economy is very sound. Not only that, it is one of the fastest, in fact, the fastest growing large economy, with 6% plus, and we had a little bit of, slowdown, which was there in last quarter, and then next quarter it picked up. And, we have inflation under control. We have very sound fiscal, policies in place. There is a fiscal roadmap which is completely under control. We had a 1 lakh crore of, the additional tax relief which was given to the middle class in order for them to actually boost consumption, savings or investments. So we have, things are in place. If you are to say inflation under control, growth is in place, savings and investments sticking, consumption picking up, and I think capital formation, both on the government side as well as in the private sector side, on the upswing. So, and you have several policy ecosystem which is in place in terms of, for example, PLI system, where whole lot of industries have come into India, the electronics industry which is coming into being, the tax system has actually responded to their problems and brought in all kinds of, facilitation in this budget as well as in the previous budgets. So therefore, there is no reason why there is, despite the economic uncertainties that some of the geo-fragmentation as well as tariff barriers and other things on the trade side bringing, despite that, India has the biggest potential as a large economy. And so therefore, that's the ground, because fundamentally, the markets will have to track the performance.
Absolutely. And if markets track performance, what about factoring in any risk elements? In your assessment, sir, what are the risk factors that any investor, large or small, should factor in today?
Well, so far as the risk is concerned, I think there is a normal market risk. And of course, as you said, that there is a heightened risk on account of global geopolitical and geoeconomic consideration. Some of it was visible right from COVID. If you see the post-COVID, a lot of realignment started taking place in terms of geoeconomic fragmentation. Because supply chains did not work and people had to do, and then you had Ukraine crisis and you had the Middle East crisis as well. So therefore, everyone wants to reshore the supply chains and, work it out their own way. And then, you have now new uncertainties arising from US administration's new stance on tariffs. I think these are the things which keep coming to the, global economy. You will see that, time and again, these things will come. We are not really in a benign environment, global environment. There will be a problem on growth. There will be a problem on global growth and global trade. People are trying to work out what are the, in what way they can mitigate the problems. For example, India has worked out, at least trying to work out a bilateral trade agreement with US, and also trying to have several FTAs with many other countries of the world. So therefore, those things will be there, uncertainties are there. But those risks apart, there are other risks which normally will come as a matter of fact in any investing. And when you balance a portfolio and you have to see, you are not really, you don't have very heavy positions in one particular this thing. You have to balance between the debt and the equity and so on.
Let's turn to retail investors, because your mandate is not just to manage the market, grow it, but also oversight and ensuring that the markets remain stable at all times. The institution has been proactive in protecting retail investors. There have been lots of measures and decisions that have been taken to safeguard them. Yet this seems to have led to a significant decline in trading volumes. That has led to its own consequences of higher competition. How do you see this playing out? Is this something that you as the head of the institution are comfortable with, sir?
Well, first of all, I would like to really say, I think what you are referring to is the derivative market, but I would like to give you a holistic picture, because retail is very much there in cash market in a big way. Look at the kind of retail protection that our system has provided. When you want to enter, you want to have ease of entry while you want to invest. So we have 95% of the time, we have Aadhaar-based authentication in KYC. So therefore, you can start investing very, very easily in India. It's not only the app, it's also the whole KYC process and so on. Then you say that if you want to, have the transactions, then what happens? How are you protected? And due to the efforts of SEBI and other market players, we have been able to ensure a system where there will be no default risk due to default of the brokers. We have upped the money and the security in a manner. For example, all the money rest will go to the clearing corporation. It will not be with the clearing members. It will be really secured with clearing corporations. And all the securities will be directly credited by the depositories to the accounts of the retailers for the investors. So therefore, your securities are not going to go anywhere. Your money is not going to go anywhere. You are fully protected. Now, third, if you want to exit, again, there is a big facilitation. Now, the other day, I think day before yesterday, we had tied up and we issued that release that we have worked out with DigiLocker. So therefore, you have this problem of unclaimed money. You do not know where the things are, and there are no record of that sometimes. So therefore, we created this DigiLocker system where you can have a nominee to the DigiLocker, where in any of the KRAs, if you have a reported death, that will be really put it out to not only to all the system, it will go to the DigiLocker, and from the DigiLocker, it will go to the nominee SMS, and from there, you will be able to know exactly and access the DigiLocker and get those claimed, all your mutual funds and securities access to. Now, this is never ever, this is not there anywhere in the world, this kind of a system. I think digitally, if you really see, we are providing the world's best practices so far as the retail protection is concerned. Now, let us come to other retail protection areas. Now, if you say that as a minority shareholders, we have had several, sometimes, that is what you sometimes also call, regulatory overreach. But from the point of view of retail investors, what we have a system of corporate governance practices, the disclosures, the independent director regulations, then you have investor education, then you have investor grievances, the scores portal through which the grievances are redressed. So you have a large number of protection, not to talk of other things which the minority shareholders, which we say that should be done, including, for example, related party transactions. So therefore, there is a sufficient thing on the investor protection which has been done. Now, coming to your volume, that means, the question you were basically wanting to ask was in relation to derivative market. Now, in derivative market, when the SEBI has done the study, 9 out of 10 retail investors have lost the money on F&O market. Sometimes, in their exuberance, the retail investors seem to think that they are very smart and therefore but actually they're losing money, and this has been proven where you have, last few. So therefore, we need better nuanced thing on that. And in order to do that,
so may I interrupt you, sir? Is a clampdown the answer, or is, like you yourself said, a more nuanced framework which allows people to take their risk? After all, it's a free country.
We need to have a nuanced, we have to have an informed investors. We have to also have some systemic improvements. Now, in terms of systemic improvement, in terms of how you measure, for example, the volumes you mentioned. Now, the volumes you can mention in terms of notional interest. Now, the point is, the notional interest is sometimes misleading in case of, because when you're comparing options and futures, they are not necessarily, it's like apples and oranges. In case of options, it is the premiums which are more, important. Now, for example, on the expiry day, you will have hordes and hordes of people. There will be just before 3 minutes, 4 minutes of the expiry day, if the people are really crowding thing, and it will lead to a market instability problem. So therefore, we had this regulation that means we have a weekly expiry. So now we have also put out a paper and people have reacted. We will actually work it out. Number one, the metrics of measurement must change. And secondly, it cannot be one-way street. Like, it cannot be that only the very large organized players must always be making money and the retailers must always be losing money.
Absolutely. Point that you made earlier, is there more work that needs to be done on corporate disclosure, sir, as we wind down the conversation? Because while so much has been done in terms of corporate disclosures, and if you talk to company executives, they may say that there is perhaps a burden there. But from an investor point of view, do you feel the need?
From the investor point of view, there is a big need for corporate disclosures because that's the way the disclosures will happen. But at the same time, we have to again strike a balance between how much of the disclosure should be there. So there was an issue of what is materiality. And there, I think a certain kind of clarity was provided by SEBI as to what is a material information that needs to be disclosed and when. I think after that clarity, I believe there will be a greater deal of certainty to the people, both to the corporates, because corporates also need more clarity. Sometimes they are also under doubt. So to that extent, if the Industry Standards Forum has developed certain things and we have defined the materiality and the frequency, and that has really settled the issue to some extent on the corporate disclosure.
When I used to meet
But let me tell you, there are corporate disclosures which are also, there are malpractices available, there are blatantly false disclosure being made, but our surveillance system is throwing it out. and therefore we will not hesitate in taking actions against such disclosures.
When I used to interview Mr. Pandey in Delhi during his disinvestment role particularly, one would be struck by his ability to understand valuation and timing in the markets. But I never knew that Mr. Pandey would have such depth that he has demonstrated. And I know this conversation could have extended for an hour on the intricacies of the market. And it's very clear, ladies and gentlemen, that SEBI, protecting the interests of millions and millions of investors in India and all over the world in the Indian market, is in absolutely safe hands. Mr. Pandey, thank you very much, and we wish you all the very best for this very critical assignment.
Thank you so much, Mr. Pandey, for being with us and sharing such wonderful insights. May I please request you to be on the stage while I invite Mr. Dinesh Pandey. Of a healthcare